Imagine a multi-billion-dollar planetary rover, right? Making this, like, absolutely perfect descent onto the surface of a distant moon.
Yeah, the kind of thing that takes decades to plan.
Exactly. It's got the most advanced artificial intelligence ever coded, a chassis made from space-age composites and sensors that can, actually detect microbial life.
Right.
But then imagine that entire mission just failing. The rover turns into a very expensive piece of orbital junk, all because a tiny $5 stainless steel clamp rattled loose during the landing sequence.
Oh, man.
Yeah, it severs a coolant line, fries the computer, and that's it. Millions of dollars gone over a clamp.
I mean, that is literally the ultimate nightmare scenario for any engineer. And honestly, it perfectly illustrates this massive blind spot we all seem to have when we look at the future.
What do you mean?
Well, we are completely mesmerized by the software, right? The algorithms, the AI, the digital magic. And because of that, we just forget the sheer physical violence of the real world.
The nuts and bolts, literally.
Exactly.
Well, today we are going completely behind the scenes of that physical reality. We are doing a deep dive into a stack of financial and strategic documents from April 29, 2026.
Yeah, and it's a fascinating stack of papers.
It really is. Specifically, we are tearing into the first quarter earnings report and strategy presentation for a company called IDEX Corporation. Now, for you listening, you might not have their logo on any of the gadgets in your house, but I guarantee you rely on their engineering.
Oh, absolutely.
They make the invisible components that keep municipal water flowing, the specialized optical lenses beaming laser data between satellites, and yes, the clamps that hold the modern world together.
They really do.
So our mission for this deep dive is to figure out how this seemingly, unglamorous industrial manufacturer has quietly positioned itself as the physical bottleneck for the most futuristic trends of our time.
And to understand their playbook, we actually have to start by looking at their financial results because, honestly, the numbers they are posting are practically unheard of for a company that bends metal and builds pumps. We aren't just looking at a successful quarter here. We are looking at the math behind a massive shift in how heavy industry operates.
Okay, let's unpack that math then. Because Q1 of 2026 was an absolute blowout for them.
It was huge.
They brought in $887 million in sales. Now, the report says that is a 9% increase on a reported basis, but a 5% increase organically.
Right.
So for anyone who doesn't spend all day, reading earnings reports, what's the difference between those two numbers and why does organic growth matter more?
Sure. So reported growth is the raw total. It includes absolutely everything.
Okay.
But companies frequently buy other businesses, right? Or they benefit from favorable currency exchange rates if they sell globally.
Mm-hmm.
That can make a company look like it's growing when the core business is actually just stagnant.
Ah, so it masks what's really happening.
Exactly. Organic growth strips all that noise away. It subtracts the recent acquisitions. It takes out the currency fluctuations to show you if the underlying pre-existing business is actually attracting more customers.
So a 5% organic jump.
In heavy manufacturing, it's a signal of massive, genuine demand.
Wow. And that demand is translating directly to the bottom line, too. Their adjusted earnings per share jumped 14% to an even $2.
Which is very strong.
Yeah, but their reported earnings per share went up a staggering 28% to $1.61. Plus, they pulled in $988 million in new orders.
And that's a 10% organic increase right there.
Exactly, meaning the demand is actually accelerating as the year goes on. But the number that really stopped me in my tracks was their profitability.
Like on the margins.
Yes, their adjusted EBITDA margin expanded by 50 basis points to reach 26.0%.
Right, let's translate those basis points for a second. 50 basis points means they are squeezing an extra half a penny of pure profit out of every single dollar of revenue compared to last year.
Which doesn't sound like a lot until you scale it up.
Exactly. When you're processing nearly $1 billion a quarter, those half pennies turn into an absolute fortune. And a 26% profit margin overall is just staggering.
It really is.
I mean, there are flashy Silicon Valley software companies that don't enjoy 26% margins, let alone factories producing physical hardware.
Which brings us to the obvious question, right? How are they pulling that off? Because you read through their strategy documents, and they constantly credit this business philosophy they call the 80-20 framework.
Yes, 80-20 is their core engine.
My initial read on this was that it sounded kind of like, Marie Kondoing a corporate portfolio.
Marie Kondoing, I like that.
Yeah. Like, you look at hundreds of product lines, and you ask, does this spark joy? Or, well, in this case, does this spark profit? And if it doesn't, you just ruthlessly throw it out.
That's a great analogy. The pruning aspect is certainly a massive part of it.
Hmm.
But to truly understand the mechanism of 80-20, we have to look at the Pareto principle.
Okay, remind me what that is.
Sure. So an Italian economist named Vilfredo Pareto noticed over a century ago that 80% of outcomes come from just 20% of causes.
Yo, right, right.
And in business, it usually translates to 80% of your profits coming from just 20% of your products or customers.
So most companies are just wasting a massive amount of energy managing a catalog of products that barely make them any money.
Precisely. The average industrial conglomerate just accepts that 80% of mediocrity as a cost of doing business. But IDEX, they use the 80-20 framework to aggressively identify the high-friction, low-reward bulk of their business, and they systematically pivot away from it.
So they just ditch the dead weight?
They do. They take all the engineering talent, the factory floor space, and the capital that was tied up in those low-margin commodity parts, and they aim it like a laser at the 20%.
Right. They call their advantaged markets.
Exactly.
I want to dig into that term, actually,
Yeah.
advantaged markets, because the presentation outlines how they are targeting global OEMs, right? Original equipment manufacturers.
Right.
They don't want to just sell a generic valve to a distributor. They want to be designed directly into the DNA of the most complex, mission-critical technologies being built today.
And there's a very specific reason for that. Because if you just sell a generic valve, your customer can easily swap you out for a cheaper competitor.
Yeah, they just go with whoever is cheapest that day.
Right. The only thing you can compete on is price, which absolutely destroys your profit margins.
Yeah.
But if you engineer a component that is utterly essential to a highly complex system,
Where a failure means total disaster.
yes,
Yeah.
then price is no longer the deciding factor. Reliability is. You become deeply integrated into the customer supply chain,
Yeah.
and that creates durable, long-term pricing power.
And that is how you hit a 26% margin.
Exactly.
Okay, let's move from the financial theory into the actual engineering, because looking at what IDEX considers an advantaged market feels like reading a sci-fi novel.
It really does.
The sources highlight three primary areas seeing massive tailwinds: space and defense, semiconductors, and data centers. Let's look at space first.
Yeah.
They have a brand under their umbrella called MART, which specializes in porous filtration and flow control for thrusters and propulsion feeds. Now, on the surface, filtration sounds incredibly mundane.
It does, until you introduce the physics of the vacuum of space.
Right.
You aren't just filtering dust out of the air here. You are dealing with highly volatile chemical propellants moving under extreme pressures. A standard filter would either clog immediately or literally shatter under the kinetic stress.
Wow. So what does MART do differently?
Well, Mott engineers materials at the microscopic level. They literally create precise uniform pores in solid metal to ensure gases diffuse perfectly.
Solid metal filters, that's wild.
Yeah, because if the propellant flow into a satellite thruster isn't absolutely uniform, the combustion is uneven, and the satellite gets thrown completely off its orbital trajectory.
Wait, really? So the entire multi-million-dollar satellite relies on a piece of porous metal to actually steer? That is insane. And they're doing the same thing for data transmission too, right? IDEX Materials Science Solutions builds the optical sensing components that allow satellites to beam information via lasers.
Right.
I assume this solves the bandwidth problem. Like, we have so many satellites taking high-resolution imagery that traditional radio frequencies just can't beam the data back to Earth fast enough.
That is the core bottleneck, yeah. Laser transmissions solves the bandwidth issue, but it introduces a massive physical problem, which is thermal expansion.
Oh, because of the temperature changes in space.
Exactly. A satellite in orbit experiences extreme temperature swings as it moves in and out of the Earth's shadow. Traditional optical lenses warp under those thermal loads.
And I'm guessing a warped lens is bad news for a laser.
It's catastrophic.
How?
Even a microscopic warp in a lens will cause a laser beam to miss a receiver thousands of miles away. So IDEX has to engineer optical components that maintain perfect structural integrity, regardless of the temperature.
Okay, that is super futuristic. Which brings me to the division that gave me the biggest case of whiplash in this entire document.
Let me guess. Band IT.
Yes, band IT. We are talking about the absolute peak of human ingenuity here. Lasers in space, autonomous AI, quantum processors. And the band IT division makes Stainless steel clamps.
Stainless steel clamps.
I genuinely have to push back here. How does a company claim to be operating in an elite, highly engineered advantage market when they are selling something I can ostensibly find at a local hardware store?
It's a fair question.
Right. Like, why couldn't an aerospace company just buy clamps from a cheap overseas factory for 50 cents a pop?
Because the cost of failure is astronomical and the operating environment is violently hostile.
Okay, walk me through that.
Let's take the explosive growth in AI data centers, which the earnings report explicitly calls out as a major driver of demand right now.
Yeah, everyone is building data centers.
Right. To run the thousands of advanced GPUs required to train a new AI model, you generate enough heat to literally melt the server racks. Air cooling just doesn't work anymore.
Right, they have to use liquid cooling.
Exactly. You have to pump chilled liquid directly through the server banks.
So you have miles of hoses running right next to millions of dollars of sensitive electronics.
Now imagine trusting a 50-cent mass-produced clamp to hold a high-pressure liquid line directly over a $500,000 server cluster.
Oh wow. Yeah, a single leak destroys the hardware and halts a massive AI training run.
Precisely. The stainless steel clamping systems Band IT engineers are designed to withstand constant thermal cycling, extreme pressure, and immense physical vibration without degrading a fraction of a millimeter over years of operation.
That makes total sense when you put it like that.
And the same applies to planetary rovers. The vibration of a rocket launch alone will turn a commercial clamp to dust.
So a cheap clamp is literally the most expensive mistake you could possibly make. So the software revolution is entirely bottlenecked by the durability of the hardware.
It's the ultimate reality check for the tech industry, you know. You can write the most elegant code in the world, but it has to live inside a physical machine. IDEX provides the picks and shovels for this new gold rush.
They aren't trying to build the AI.
No, they're selling the thermal management components that stop the AI from incinerating itself.
That is fascinating. Knowing that, I want to look at how this company actually organizes itself internally, because IDEX isn't just one big monolith, right?
No, they divide their business into 3 distinct reporting segments.
Yeah, and I think there's a profound business lesson here for you, the listener, regarding how to manage different phases of growth. Like, does a high-tech pivot lift the entire company, or are the traditional legacy divisions just left to slowly die out?
That's a great question to ask.
Let's start with the darling of the group, Health and Science Technologies, or HST. This is where the AI and space components live. In Q1, their sales hit $398.4 million.
A massive chunk of change.
Yeah, that's a 17% reported increase and an 11% organic jump.
And their profitability skyrocketed alongside the revenue. The adjusted EBITDA margin for the HST segment expanded by a full 100 basis points, hitting 26.6%.
Wow, an entire percent jump in margin.
Yeah, but what is crucial here is the forward-looking metric, their backlog.
The orders waiting to be filled.
Right. The earnings report notes that the order backlog is actively building, specifically because of the semiconductor, AI data center, and space defense markets. The demand is actually outstripping their current capacity to fulfill it.
Which is a great problem to have. And they are actively buying up other companies to expand that capacity, right?
Yes.
The sources point out a July 2025 acquisition of a company called Microlam that significantly boosted this segment. And it is worth noting, they achieved all of this double-digit growth even though they actually saw lower sales volumes in their life sciences businesses.
It's a testament to the strength of those advantage markets.
Absolutely. But let's pivot to the second segment. Fluid and Metering Technologies, or FMT.
The workhorse.
Yeah, exactly. If HST is the superstar, FMT feels like the steady blue-collar worker. They handle municipal water systems and mining applications.
Right. FMT is an excellent barometer for the general industrial economy. They reported $301.5 million in sales, which is a solid 4% reported increase, or 2% organically.
Not flashy, but solid.
Exactly. The demand in water and mining was strong enough to offset a noticeable slowdown they experienced in the global chemical markets.
I see. Their margins did slip just a tiny bit, down 10 basis points to 32.7%. But honestly, a nearly 33% profit margin on heavy fluid metering equipment is wild.
It really is.
Which brings us to the third segment, and this is where I really need your analysis on this.
Okay.
The third division is Fire and Safety and Diversified Products, FSDP. They pulled in $188.3 million in sales.
Right.
Now, that's up 2% reported, but when you strip out the noise, the organic sales actually shrank by 1%.
Yes, they did.
They had good fire and safety demand in North America, but their dispensing markets were weak, which kind of dragged the whole segment into negative organic territory.
That's right.
So looking at this through the lens of that 80/20 strategy, is FSDP the bloated 80%? Like, are these traditional legacy divisions just stagnating while the company focuses all its attention on lasers and data centers?
I get why you'd think that. It's deeply counterintuitive, but to find the real genius of IDEX, you have to look past that negative sales number.
Okay, I'm listening.
You have a segment where organic revenue actually shrank by 1%. Normally, when sales drop in manufacturing, profit margins utterly collapse due to a phenomenon called volume deleverage.
Because you still have to pay to keep the massive factory running and the lights on, right? But you have fewer products going out the door to absorb those fixed costs.
Exactly right. So gravity dictates their margins should have plummeted. But instead, FSDP's adjusted EBITDA margin actually increased by 30 basis points to 29.7%.
Wait. Their sales went backward, but they squeezed more pure profit out of every dollar they made. How is that physically possible?
Unrelenting operational discipline. This is the hidden half of the 80/20 philosophy.
Oh, see.
When a market isn't growing rapidly, you don't chase expensive, low-margin sales just to make the top-line revenue look good. You optimize the factory floor. You cut manufacturing waste. You utilize extreme pricing discipline.
So they just get incredibly lean.
Yes. They made their processes so efficient that productivity improvements completely neutralize the penalty of selling fewer units.
That is a phenomenal takeaway for anyone running a business. A slow growth division doesn't have to be a failure. If you run it efficiently enough, it becomes an absolute cash cow.
And that cash cow is the engine for everything else.
What do you mean?
Well, the immense profits generated by the steady FMT and FSDP segments provide the financial foundation IDEX needs to fund the expensive R&D and those massive acquisitions in the high-growth HST segment.
Oh, wow.
They don't have to take on dangerous levels of debt to chase the AI boom. They self-fund it by running their legacy water pump and fire safety businesses better than anyone else in the world.
That is brilliant. Let's follow that money trail, actually, to see exactly what they are doing with those profits. This brings us to our final section, looking at the cash flow and predicting the rest of 2026.
Let's do it.
I was looking at the cash flow statement, and I have to admit, my alarm bells went off a bit.
Really? Why?
For Q1, their free cash flow was $86 million, which is a 6% drop compared to the prior year. If they are having such a blockbuster quarter with margins expanding everywhere, why is the actual pile of cash left over at the end of the day shrinking?
It's a valid concern.
Right. In what universe is a drop in cash flow a good thing during a boom?
It's an excellent catch, and normally a shrinking cash pile warrants immediate skepticism. But the financial tables in the source material give us the precise anatomy of that 6% dip.
Okay, so what's causing it?
A small portion of it is simply the timing of customer payments. In complex aerospace contracts, invoices don't always clear evenly at the exact end of a quarter.
Sure, that makes sense.
But the primary driver of the dip is a deliberate, massive spike in capital expenditures.
Oh. So they aren't losing the money, they are actively spending it on themselves. They are building out their own capacity.
Yes. When your backlog in space tech and AI cooling is swelling to record levels, your biggest risk isn't finding customers. Your biggest risk is not having enough factory capacity to build the parts you've already sold.
Ah, so you have to spend money to make money.
Exactly. A spike in capital expenditure means they are pouring concrete, buying advanced machinery, and aggressively expanding their footprint to capture the massive demand in those advantaged markets. It isn't a red flag. It is the ultimate green light.
And they are so confident in the cash they are generating that they are still returning capital to the people who own the stock.
They are.
The report says they maintained a flexible balance sheet while executing $76 million in stock repurchases and paying out $53 million in dividends just in the first 3 months of the year.
Which is a huge flex. That combination, heavy internal reinvestment, paired with massive shareholder returns, signals an executive team that believes their cash flow generation over the next several years is absolutely locked in.
And they explicitly put that confidence on paper with their forward-looking guidance, didn't they?
They did.
They raised their full-year 2026 organic sales projection. They were previously predicting 1 to 2% growth, and they bumped that up to an increase of 3 to 4%.
A significant jump.
Yeah, and they also raised their adjusted EPS guidance for the year to a range of $8.35 to $8.55.
Right.
Looking at the immediate horizon for Q2 specifically, they expect that 3 to 4% organic sales growth to hold steady with an adjusted EPS of $2.07 to $2.12.
And, when management raises full-year guidance in the very first quarter, it is a definitive message to the market.
What's the message?
It means the surge they saw in Q1 wasn't a fluke caused by, a single large contract. It means the 80/20 pivot is yielding systemic, highly predictable demand. They have enough visibility into the back half of 2026 to comfortably raise the bar on themselves.
Amazing. So if we pull all these threads together, what is the ultimate takeaway here? We started with a stack of earnings tables from April 29, 2026, but what we actually unpacked was a masterclass in modern industrial strategy.
Truly.
IDEX is using the Pareto principle to relentlessly hunt down the most critical, high-stress bottlenecks in the global economy. They're engineering the optical lenses that make space data transmission possible, the precise filtration for satellite thrusters, and the fail-proof clamps that prevent AI data centers from melting down.
All the invisible stuff.
Right. And they're doing it all by using extreme operational discipline in their legacy businesses to fund their futuristic ambitions.
It's a perfect machine. And I think the takeaway for you to consider as you watch these macro trends unfold is this profound shift in where true leverage lies.
Tell me more about that.
Well, as global infrastructure becomes infinitely more complex, as we try to colonize space, roll out artificial intelligence, and build next-generation satellite networks, the true limits of human progress are no longer digital. They are physical.
Wow.
We spend endless hours debating who controls the software, who owns the code, and who develops the best AI models. But the software is entirely subservient to the physical hardware that houses it.
It has to live somewhere.
Exactly. Perhaps we need to be paying much closer attention to the hidden industrial manufacturers, the companies forging the alloys, building the valves, and engineering the clamps, because they are the ones holding the physical keys to the next technological frontier.
The entire digital revolution is precariously balanced on a foundation of stainless steel and porous metal. That is a wild thought.
It really changes how you look at the tech world.
It does. Thank you so much for joining us on this deep dive. Whether you are managing a corporate portfolio or just trying to understand how the future is actually being built, remembering that the invisible layers of our world dictate what is possible is the ultimate shortcut to being well informed. Keep looking past the headlines, and we will catch you on the next deep dive.